So the S&P 500, we're looking for a move up to 2936. So that would equal to wave 1. Now, all we need is 5 waves up. It doesn't have to be an ending diagonal, but typically you see the final 5th wave as an ending diagonal, so it's quite possible. Good morning, TradingView. So we're going to have a quick look at the S&P 500, but before I get into it, I want to talk about my journey in trading, and then I've got an announcement to make after that. So before I used TradingView, I think I began using TradingView about 4 years ago. Before that, how I used to develop trade ideas was through Yahoo Finance, and I used to download price data into a spreadsheet. And the strategy that I used was very different to today. It was a hedged portfolio, and I used to hedge intra-sector risk. So you've got market risk where let's say you bought Apple and you shorted the S&P 500 just in case the S&P 500 dipped and Apple dipped as well. You'd be able to offset some of those losses. So that's market risk. Then you've got sector risk. So you would short, let's say, for argument's sake, if you bought Bank of America, you'd short XLE, the financial sector ETF. So you would hedge against sector risk. And then you got intra-sector risk, where for argument's sake, you would be, let's say, long JP Morgan Chase and short Bank of America. And that was a strategy that I used to use. And the reason I used to, and how I used to develop that was, I used to use momentum indicators. So I used to follow price action of the spread over a couple of weeks, and then I'd buy into it. And as you can imagine, the volatility is going to be much lower, because whatever drives banks, a rising tide lifts all boats, right? So if one bank's going up, they all go up. So you have to be very meticulous and find the strongest performer and then short the weakest performer, and then you'd make the spread in between. And as you can imagine, the return on that is going to be very low, so you can afford to use massive leverage, 5 or 6 times book, but it still would never really affect your portfolio because you're making a spread. Where I turbocharged my returns was when I figured out that if I set up a holding company, a limited holding company, I could write off my losses against my taxes. So that increased my performance dramatically, and that worked perfectly for me. A few years ago, I diversified my risk. I started allocating money to startups. I started allocating money to real estate and different investments across the board. So my strategy had to change. I then transitioned into a smaller portfolio, and I started to use TradingView, and my performance dropped massively. The reason my performance dropped massively is because despite being very successful prior to that, I never had like price data and chart information by the second in front of me. So I could never discount what my portfolio was at any one given time. So it allowed my emotions to stay in check. It's almost like if you go and buy a home, certainly I bought real estate prior in Ireland, and I got a 92% loan to value. So if you can imagine, I'm massively leveraged. I'm 12.5 times leveraged on that home. But when I buy it, as long as I can make my monthly repayments, I never think about the actual value of the property. I never think about it because it doesn't have a price indicator above the door that tells me every second what it's worth. So I never get the urge to sell it. And that's why the strategy prior to using TradingView worked fantastic. And when I started using TradingView, I started to follow my portfolio a little bit more meticulously. And every single small peak and valley, I would start to get from a psychological standpoint. And I used to get a little bit worried, make irrational decisions, and my performance dipped. It took me a bit of time to get used to that. And the reason I'm saying all this is because despite having a lot of experience trading, I still succumb to massive psychological issues. And when you come to TradingView, everybody has their own opinion. There's thousands of people that post their ideas, and everybody has a completely different idea. 95% of those ideas have zero empirical evidence to suggest why a stock or an asset is going in a certain direction, yet they still have the freedom to post it. And to me, that's wrong. The second thing is, when I post a chart, I have a specific portfolio parameter which hedges my risk. As I said, prior to TradingView, I had a very hedged portfolio which allowed me massive leverage. And although the performance in terms of percentage return was really low, I was making all the money on the tax write-down. So that was my strategy before. You guys don't know that. And when I put out an idea and I talk about an idea, you guys don't know my portfolio parameters. The reason I'm bringing all this up is yesterday I put out an idea, short gold. It worked perfectly. It was down 1.5%, I believe, yesterday at one point anyway, at least. And then a lot of people see that and all of a sudden they believe that every single trade that I put out is going to be just like that. And that couldn't be farther from the truth. I would say my performance, I get about 60 to 80% of my ideas right, and there's an awful lot of ones that I get wrong. Usually when I get an idea wrong, it clusters. I get a few of them wrong at a time, and usually when I'm right, I'm obviously in the rhythm of the market, and I can get a few of them right at any given time. So people follow my idea, and they will follow my ideas, and the next trade, they'll put not just all of their money on it, they'll put a massive leverage position on it, and it starts to go against them. And next, I don't know these people, they reach out to me and they say to me, hey, I'm down X amount, I need to get this money back, I followed your idea. I don't know anyone's parameters, and so it's very easy for me to say, hey, look, it's your own fault, you shouldn't be following other people's ideas, but that weighs heavy on me. And although I do have a service and it's beneficial for me to post my ideas, it's not worth it to feel the way I do when someone reaches out to me and tells me that they're losing a lot of money from following my ideas. And a lot of it has got to do with not fully understanding. Obviously, risk management is the first thing. Forget about macro and fundamentals. Risk management is the first thing you start with before you put a dime on the table. You need to know what you're prepared to lose. You don't just take all of your money, put it down and say, we'll see what happens. That is ludicrous, and it weighs heavy on me. So the announcement that I'm making is I'm likely going to migrate to a different platform, possibly YouTube. And the reason being is because I think my updates need to be more education based for my following, and not necessarily charts, because I think that 50% anyway of the following need to understand how to trade first. And yes, I do have a service, but there's still an awful lot of stuff that I could help you guys with. Those of you that are in the deep dive, don't worry, I'm still going to do my weekend reviews. Gentlemen, Dominic reached out to me yesterday. Thank you, Dominic. I usually only hear the bad news, but Dominic gave me some good news. He said over the past year he's learned an awful lot. So thank you, Dominic. I really appreciate that. Dominic suggested that the weekend reviews, the deep dives, are transitioned into video format. So that's something I will take on board, and I'll figure out a way of doing it in video format. Anyway, those of you that are part of the deep dive, don't worry. That's a controlled environment. You guys can reach out to me. I know who you are. I know what your situation is, and we can work on it from there. But as I said on TradingView, it's very hard to control risk management for people that are new to trading, and it's something that I don't feel comfortable doing, putting ideas out there and allowing somebody to lose all their savings foolishly. So this weekend I'm going to do a massive update, likely on Sunday once I finish my weekend review, over every asset class, and it's probably going to be the last one, unfortunately. As I said, I'm likely going to migrate over to YouTube, and we can do a little bit more education based, I guess. Anyway, guys, that aside, let's have a look at the S&P 500. So the S&P 500, we're looking for a move up to 2936. So that would equal to wave 1. Now, all we need is 5 waves up. It doesn't have to be an ending diagonal, but typically you see the final 5th wave as an ending diagonal, so it's quite possible. What I have measured out here is a wave 1, running flat here for a wave 2. This is possibly a wave 1, 2, 3, 4, and this is the final 5th wave here of wave 3. Then we get a wave 4, and then a final 5th wave higher here to complete off 5 waves. I would not be shorting it right now. Going back to the example I said a moment ago from my old strategy, the less you look at this, the better. Just come back in a couple of days. The closer we get to 2936, then you start focusing on it. Then you can look at it every day. But until we get closer to that target, don't look at it every day. It doesn't matter. You're not going to make any more money on the upside here, and it's not time to short it just yet. Not while it's going up like this. So give it some time. Patience pays more money than you would ever imagine. So yeah, wait till at least 2936. The risk on this trade is to the upside, and the reward is to the downside, but only at the right amount. What we would expect on the downside is a 61.8% Fibonacci, which I have marked out. Should have it marked out slightly higher there 236, which brings us in at 2566. However, look at this cluster here of support. This might be an area where it stops, somewhere around this area here. See this cluster here of support? We may only get down as far as 2629, but still that's a good return. At the very least, I'd be reducing half of the position here. If it started to bounce higher, obviously you get out of the rest of your position. If it got down to 2566, I'd be closing out the position entirely. The data does not suggest we're going into a recession, and there should be no reason why we continue to hold it lower than there. So guys, that is my expectation on the S&P 500. Wait for 2936, and then, as I said, the first target you should be taking money off is 2629. Anyway guys, any questions, please do reach out. Have a wonderful day, and look out for the weekend review, likely the last weekend review this weekend on my channel. Have a great day everyone, all the very best.